Hey everybody. So today we're actually going to be talking about trading options on Robinhood for beginners. So this is strictly for beginners, people that have never done options before. They don't know what what this is all about. Maybe they have a Robinhood account already and you've, bought a couple shares of stock and now you've heard that options are the way to go. So we're going to talk about trading options in Robinhood for beginners. This is actually going to be a 4-part video, so you can check out the other parts as we go along. We're going to kind of break this up into these 4 parts so that it's not so overwhelming and so much to consume all at once. This first part is going to talk about what are options, just the basic overview of what options are, and then we're going to have other videos that kind of talk about a little bit more of the details around options and buying and selling and that kind of thing. As always, I'd appreciate it if you subscribe to my channel, like this video, like the other videos. If you enjoy them, make sure you leave some comments in the comment section so that I can improve things if need be, as I'm always looking to make these as valuable for you guys as possible. So what are options? All right, so options are a contract between a buyer and a seller. Okay, just basic overview. An option is a contract between a buyer and a seller. Now, you can have 2 types of options contracts. You can have calls, which you are betting that as the buyer, we're going to be the buyer in this situation. You are betting that the stock is going to go up. All right, and then the reverse of that are puts. You are betting that the stock is going to go down. Right, so very basic information. So options are contracts between a buyer and a seller. Calls, you're betting that the stock is going to go up. Puts, you're betting that the stock is going to go down. Okay, so if you want to follow along, just open up your Robinhood app on your phone. And I'm just going to go to the search. I'm going to type in DKNG for DraftKings. I'm going to hit trade options, and then I'm going to select a date. We're just going to go with January 29th, and here you're going to see a few different options. Okay, so we're going to transition here, and again, for these purposes, we're going to be the buyer, and we're going to focus on calls. So puts are a different thing. Being this on the selling side is a different thing. Those will be other videos later on that I'll put together. But for right now, we're going to focus on being the buyer, and we're going to focus on buying calls for the examples that we're going to use in these videos. So again, an option is a contract between the buyer and the seller. It is the option, it's giving the buyer the option, not the obligation, to purchase 100 shares of the underlying stock. So the stock in this case, right, is DraftKings. That is called the underlying. So when you're talking about, buying options on a stock, the stock itself is considered the underlying. So if you hear people talk about underlying, they're talking about the stock. So it's giving you the right, not the obligation, to buy 100 shares of the underlying stock at a specific strike price. Now I know that may sound confusing. We're going to go over it here. Okay, so I mentioned strike price. Okay, so right now, as I mentioned, we're going to focus on the buying side of an option, and we're going to focus on calls. And again, just a reminder, the calls are you betting as the buyer that the stock is going to go up. Okay, so the next piece is the strike price. So the strike price are these numbers here. All right, so $51 call, $50.50 call, $50 call, $51.50 call, $52 call. All right, those are the strike prices. So when you're buying a call option, you are going to bet that the stock is going to go up, and we'll take this option here, this $50 call. We're going to say that we're going to have the right to buy 100 shares of DraftKings at $50 strike price, right? And you're sitting there probably saying, well, Right now, the share price is $51.20. So how could I buy it at $50? Well, that's what options are. You are buying the right to exercise a contract between you and the seller to say, I'm going to buy 100 shares of this stock for $50. Now, let's break that apart a little bit. Here is the current trading price, $51.20. These options here are called in the money options. Basically, it means that the strike price is lower than the current trading price of the stock. If there were options right here, that would be considered at the money. So not that there are options that are, right at the same strike price, but if they were, they would be considered at the money. And then options up here are considered out of the money. They are strike prices that are above the current stock's trading price. So if we wanted to take a quick example of this, right? If we purchased this $50 call, okay? So we're going to purchase, 100 shares of DraftKings at $50, right? That's $5,000. And then we're going to turn around and we're going to sell those 100 shares at the current price of $51.20, which would be $5,120. We would then instantly make $120 profit. Now we'll get into premiums and things like that. It's not that easy, but I just want you to get the concept of buying an option in the money instantly has what we call intrinsic value. And we'll talk about intrinsic versus extrinsic value in the next section. But I just want you to get the concept that you are buying an option that's in the money because the strike price is lower than the current trading price of the stock. So if you buy and then resell it instantaneously, theoretically, you would make the difference between the current trading price and the underlying stock or the underlying strike price. Okay, so we went over quite a bit in this video. I want to take a pause before we move on to part 2, which is talking about the premiums of these options. So I want you to focus on understanding, asking yourself 5 questions. What are options? Number 1. What is a call versus a put? What is a strike price? What does it mean to be in the money, at the money, or out of the money? And then what is the underlying? So if you can basically regurgitate what I just talked about in this video and define all of that and have a good conceptual understanding of what those are, then you're ready for part 2. Just a reminder, if you did like this video, please click the like below, add any comments down in the comments section, and of course, please subscribe to my channel. I appreciate everybody's feedback and everybody's participation. We do have a Discord group. Please check out the link in the description. If you want to help support this channel and my Discord group, you can sign up for a Robinhood account if you don't already have one, or ask your friends to sign up using my referral link, or you can Venmo me at Jonathan Van Horn. Really appreciate it. Thanks again, and we look forward to seeing you again soon.